Hi student, today I'm going to teach the chapter 22, Analysis and Interpretation in Business Performance. Okay, this topic we will cover three-part introduction on what is the difference between analysis and interpretation, and who are the user for the financial statement, and also um, the terms and calculation and terms and formula used for this topic. And also we are the main concern for this topic is the three profitability ratio and the five liquidity ratio. It's very important to analyze and interpret the business financial statement so that the owner will know how well the business go, how well the business performs. So as usual, usually we use the financial statement IS and SOFP to see the data of the year, how well the sales they can have, and are they making a gross profit, and are they making profit or loss for the year, as well as they can see up to today, up to this year end, how much NCA they have and how much the loan they have already taken, and they can't calculate out or see the result comparative by the year by year by seeing the ratios of the GP they make and how much they use their capital to generate the sales. But by doing this topic, we will analyze in more detail by using the difference of the profitability and liquidity ratio, so that after that we can interpret according to the result that we have calculated out. So therefore analysis is just to see the data of the financial statement and see how to assess the performance of the business. Interpreting is comparing result by using the similar business like Gardenia business compared to the Massimo, so you can see which company can do well, which company plan well, which company have budgeting well. So all this you can see, and you can compare within their own internal business as their own business as well. With the result, you can see the progress and to make a target and budgeting for the future. To enable this comparison to carry out meaningful way, the result usually expressed as an accounting ratio. Only accounting ratio will give you more precise analysis. Two main groups of the ratio we are going to discuss, which are profitability and liquidity ratio. Profitability ratios are those ratios, there are total of three of them. So ROCE, profit ratio, and gross margin ratio and profit margin ratio. These three are seeing how well you manage, how well the company perform, how well the company use the capital to generate the sales. And liquidity ratios are five of them: inventory turnover, trade receivable ratio, trade payable ratio, liquid asset test ratio, and all this, and all these ratio are, and so on, all these ratio are seeing how well your SOFP plan, like how well your asset, how well you manage your asset, liability, and capitals. So all this I will explain in detail in the other slide later. So the terms that we need to use for this topic are working capital. I mean, those calculation we need to know with this term. So working capital difference between the current asset and current liability means that the liquidity of your companies. So after I use my current asset minus the current liability, how much money available for me to plan for elsewhere, invest for elsewhere. So working capital means. So capital owned is the amount owed by the business to the owner of the business certain date. So this is the initial capitals that I invest, and every year's profit accumulated that I keep it in the capitals account. So capital employed is the total funds that I am going to use by the business to generate the sales and to plans for the future. So the calculations for the capital employed and capital owned are different. Capital owned are the initial investments that to run the business and initial amount that are invested into the company, or the accumulated every year's profit that I keep into the companies to run the business. So capital employed is how well I use the fund to generate profit. So the calculation are either calculation formula 1 or 2. One is total asset minus the current liability, or we use the NCA plus the working capital. Working capital is CA minus CL, or the NCL plus capital. Either one formula to calculate the capital employed. You need this to apply to your profitability ratio, which is especially ROCE.